Welcome, YouTube family, and welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about a very famous YouTube guy named George Gammon. Has he cracked the housing code? There's been a big debate on both sides. There's billions of dollars that says that the housing crash is imminent, and there's people who've been saying that for years. I guess you can throw me in that camp. And there's the other ones that says, hey, we're not going to have a housing crisis, and even if we do, it's going to be small in nature. So thought it'd be interesting to talk about this because it's such a hot topic. George Gammon is a very, very smart man. I don't agree with everything that he says, but I thought this was particularly very insightful. So we're going to share some of his content on this particular show. But before we get to that point, I want to take a moment to kind of tee up some things from my perspective as to why I have taken the position that I do think we potentially could be looking at a black swan event. But before I ask that you hit that like button, if you're new to the channel, please subscribe, hit that bell notification so you are notified when I do release my videos, which is typically once a week on a Saturday. So let's talk about a lot of things before we get to this George Gammon clip. Mortgage forbearance. When the healthcare crisis came out, that came into effect, the mortgage forbearance, I think around March of 2020. So people basically went 3 years without having to pay for a mortgage. Student loans were paused for 3.5 years. The average student loan payment somewhere around $400. At the beginning of the healthcare crisis, there was excessive unemployment compensation. Excessive, I don't mean that in a derogatory standpoint. I'm just basically saying people were compensated more unemployment than what they normally would get because, basically everything was shut down. And as a result of that, a lot of people were making more money not working. Lenders' activity. So this is something I'm familiar with, dealing with pre-foreclosures. You talk to a lot of lenders, and they were doing very creative things to keep people in their homes. You actually seeing a little bit of that in commercial real estate as well, because they just don't want to take this property back. So this is atypical behavior. So why am I mentioning all of this? Because these things are atypical. So the housing explosion that we've experienced in America for the last 3 years has not gone up organically. Do you understand what I'm saying now? So you're giving credit for something that doesn't have any fundamental basis to it. That's why some people who are hard driven based on data, yours truly, and looking at history, yours truly says something has to break. And the people who are in the bullish camp are saying, hey, wait a minute, Kevin. Look at what's going on. Look how well home builders have done year to date. And it's kind of like, yeah, but all of this stuff has been artificially pumped up for the last 3 years, and it takes some time for it to work itself out of the system. So for those of you who aren't following this a little bit, but actually exercise, you'll get this analogy. It's like, when we go to the gym, there's just guys that are just stronger than you, and they just put more work into it. You guys know what I'm talking about. You're just like, yeah, that guy he just wants it more than me. But when you inject yourself with steroids, and let's say you can bench 200 pounds, and then you take steroids, and now you're benching 250 pounds, and you're bragging to your other friends that, hey, man, I bench 50 pounds more than you. And you're like, yeah, but it's not organic. You didn't fundamentally get stronger 50 pounds on your bench press. It was induced by steroids. Well, the housing market has been artificially inflated by the Fed and all of these factors that I've just discussed. So you can't, in a way, say that housing is going to be sustainable and continue to grow unless these other non-organic factors continue to be a part of your thesis. Following me now? And now that the mortgage forbearance is over, the student loan hiatus is over. So these are two big shells that are getting ready to be dropped out of the air. And these are just bombs that are just waiting to drop on the American pocketbook. So only time's going to tell. So without further ado, I'm going to go ahead and jump over to this. I just kind of wanted to tee this up because George Gammon is talking about how he's predicting the beginning of a recession in October 1 of 2023. And it's in concert with, ironically, when student loan payments are due. So without further ado, let's go ahead and key this up.
Now let's go over just some of the data that leads me to the conclusion that the United States is headed for a recession very soon. In fact, maybe October 1st. And this recession is going to be severe. It's not going to be a soft landing. It's going to be a hard landing, if not something even worse. First and foremost, let's go right over to CNBC. And they say 61% of Americans are living paycheck to paycheck, even though inflation is cooling down.
Now I'm going to stop it for 1 second because some of you might be thinking, well, hell, Kevin, people have been living paycheck to paycheck for decades. Why is this such a prominent statistic now? It's a prominent statistic now because the last 3 years, people basically weren't making a mortgage payment. They weren't making car payments. They were getting excessive unemployment compensation, and student loan payments were on pause. So when you're living paycheck to paycheck and you take those big factors out of your budget that you don't have to pay, it doesn't sting as much. Now that this thing has been, the spigot has been turned back on and all of these payments are coming back, and you throw on top of that 61% of Americans are living paycheck to paycheck, that's the reason why I think something's getting ready to crack.
So to help you get your head around this, let's go over and break these numbers down by specific income group. So they say low income workers have been hit the hardest by the price spikes you'd expect, particularly with food and other staples, since those expenses account for a bigger share of the budget. Roughly 3/4 of consumers earning less than $50,000 and 65% of those earning between 50 and 100,000 were living paycheck to paycheck. And this is as of June. I would argue that it's most likely a lot worse now. And this is based on lending.
So right there, you can see those demographics, 75% and 65%. That's mainstream middle America. That's the driver of the housing market for the most part. And people are just, as I said, are getting squeezed. So I'm going to move this down a little bit further here, and we're going to continue on this thing because I think this is very interesting. Let's see right here.
Let's go to another chart here, and we'll go back to 2008, and you see that in 2009 we had some significant real wage gains. Why? Because we actually got deflation. You guys remember back to 2009, it was either Q1 or Q2 where prices actually went down, not disinflation, but outright deflation.
Keep in mind, he's saying back in 2009, based on this chart, we had deflation. Keep that in mind because I'm going to wrap up this video and really drive home a very salient point as it relates to the great financial crisis that happened around 2007, 2008.
But since that time, even when you consider what happened here with negative real wage growth, and let's call it 2011, overall, the trend was up. And then, as you can imagine, it really spiked in 2020, very consistent with the first two charts. And look at what has happened since then. We'll call it March of 2021. I mean, we haven't seen anything like this as far as the reduction of purchasing power going back at least 15 plus years.
So what he's saying here, folks, is that you can see all of that red to the right of the graph. That's real hourly earnings when you adjust it for inflation, right? It doesn't mean anything if you get an 8% raise, but inflation's 10%. You're still down 2%. So we haven't seen that much red, for me to keep it simple. It has to go back 15 years. And even back in 2008, as you can see, relative to the real average hourly earnings, it wasn't even as bad in 2008 as it is now. This is why I'm saying something has to give.
We're seeing negative real wage growth in places like Australia, but also in Japan, in Europe, and to an extreme here in the United States. Oh, but wait, there is more. Remember, I talked about October 1st as being a specific date that you should be paying attention to. Why? Because this is when millions of Americans have to start paying their student loan once again. So at the beginning of this video, we talked about how the stimulus payments were really impacting the revenue side of their profit and loss, if you want to look at the individuals having a P&L. But we also have to consider the expense side. A lot of them did not have to pay rent. Now they're probably having to pay rent now, but they still don't have to pay their student loan. So as of September, that interest is starting to accrue again. And starting October 1st, they have to start making payments. So let's dive into the.
Okay. So I'm going to go ahead. You see the point of all of that. It makes a lot of sense. And here's the thing I wanted to bring back about when he was talking about in that one chart about deflation in 2008. So for those of you who are in the camp talking about, well, sometime in 2024, more than likely the Fed's going to pivot and lower interest rates, and that's going to reignite or excite the housing market again. So we're going to get a minor dip or sustain where we're at. And then once rates go down, the housing market is just going to take back off again. Probably not. So here's why. So I encourage you, and I'm not going to do this on this particular video, go back and look at the history of the Fed's fund rate and recessions and things like that. But here's my point. Everybody's familiar with the great financial crisis. The peak of the housing market was around July of, I think, 2006. In retrospect, they found out. And then it started to crash around 2008. So nothing goes down in a straight line, just like inflation. We're going to see inflation go down and go up and go down and go up, but prices are never coming back to 2019, 2018 levels. So it's not working. So those of you who are on low fixed income, you need to do something, because there's no way on low fixed income you can outrun inflation. Getting back to the great financial crisis point, when that happened, the Fed lowered the Fed funds rate to 0. Listen to what I'm saying, folks, because you can look this up. Back in 2008, when the Fed lowered the Fed fund rate to 0, the housing market continued to go down for another 4 years. So the peak was July of 2006, but it really didn't bottom until somewhere around the second or third quarter of 2012. So from a peak to trough, we had a 6-year period before housing market rebound. Now, during that 6-year period, there were points where it went down in 2006. It kind of went up a little bit, and then it went down, and then it went up a little bit, and then it went down. But clearly, the pattern was down. You were getting lower highs. It never got back up to the July of 2006 level. And this is why I'm telling you guys to exercise some caution, because some of you who don't understand some of the macroeconomics, that's why I encourage you to go back and look at history and say, wait a minute. This happened in 2008. We lowered rates, and that didn't save us. Imagine what's going to happen if they do that again. That could potentially spark or reunite inflation. And more importantly, look how much consumer debt we have now compared to 2008, right? All-time credit card debt, all-time student loan debt, all-time auto loan debt that's imploding. There's almost 20 to 25,000 repos per day that's happening. The subprime auto industry is imploding. So we've got way more consumer debt in aggregate in 2023 than 2008. It's not even close. So this is why some people think when this thing finally cracks, that proverbial crack in the dam, it's going to be really, really nasty. So in conclusion, it's going to be really difficult for the housing market to continue to go up at the pace that it has, because as I mentioned earlier, it was artificially stimulated. It was on steroids. That growth wasn't natural. So when you remove that artificial stimulant from the equation, things reset back to a normal level. So that's going to be it. I hope you've got a really, really good idea of the pros and cons of the housing market. And I think George Gammon is on to something. It's a moot point of whether or not it's student loans or a black swan event that ultimately has an effect on the housing market, because I'm famous for saying, if you're in an elevator and I get off on the 10th floor and you're still on that elevator and you're bragging because your pricing is still going up, you're experiencing more equity, and you're saying, see, Kevin, you should have stayed on the elevator. I'm on the 20th floor and I'm still going up. You got off on the 10th floor. I'm 10 floors higher than where you're at. But if you're on that elevator when the cables snap, it's a moot point how high you got, because ultimately you come crashing down. So I hope you enjoyed this video. Please hit that like button. Help me out. Subscribe to the channel. Hit the bell notification. I'm going to end the video with my famous slogan, keep your credit score up and your debt down. This was the Kevin Strong Show, and I hope to see you in my next one.